their expenses don't matter. We don't accept anyone's expenses. So when we're given a deal and they're like, oh, here's the expenses, it doesn't matter to me. There's reasons sellers are selling. That's why I want to know the reasons. That is money on the table that we're like, we should just be getting. We don't need rents to go up. We don't need the market rents to go up. We don't need the market to have more demand. Nothing. That's just today. What's happening, existing.
Now is truly the time to not be on the sidelines. It's time to get in the game.
Welcome everybody to Self-Storage Income, and today we're talking about underwriting. This has been one of the harder things to do in the last year and a half, and we're going to talk about why it has been difficult and how to go about underwriting for self-storage, right? Because you got to remember that value, okay, is not the price, right? Value is what it's worth. And price doesn't mean that it's worth that thing. The price is simply what market participants will pay for the storage facility. We talk about this a lot, and this is really important when it comes to underwriting. People that don't understand the difference between intrinsic and extrinsic value are the ones that get caught. They overpay for things, right? Market corrections come. They value things at basically momentary points, what market is saying, not what is the reality of the situation. Market participants, buyers and sellers, tell us what the price of an asset is on the market. They do not tell us necessarily what that worth is. One of the main reasons why is worth is different from every single person. If you can get a 5% low risk return to one party, that may be worth a lot to you. But to another party, it may not be, right? So intrinsic value is what you get. It is how much money the asset makes, okay? Then we look at what your return is predicated on different prices. The reason why this is important, everyone, is when you're underwriting assets, this isn't like a stock where you just hit buy or sell and whatever the market is what you get it at. It's not how it works. You go and you negotiate. The owner wants X. We're not paying X, we're going to pay this. Or other market participants want to pay X, but to us it's worth a lot more, so I'll pay this price, right? So the price doesn't translate into worth, and it's also not a set thing. When I hear people saying, well, every deal that I see come out on the market is too expensive for me. And I go, okay, but the deals that come out of the market, you see their price. Did they sell at those prices?
But what's the value?
Well, what's the value of it? Mm-hmm. Like it just doesn't matter. And I haven't seen in a year and a half. I'm trying to remember if we've actually looked at or underwrote a property that sold at the price it went out to market for. I don't think that's ever happened.
That's a really good point.
And all of them have been selling at far below whatever they came out and asked. So if you're just passing something up because the price looks too high for you, but that price is what has been put on a brochure or online, that price isn't what it actually sold for. Underwriting takes into account not just the value, but it also takes into account the risk and the future value, right? And that gets even more complicated. So we're going to dive into this topic today. We're going to talk about a lot of these things, and we will not get to it all in an hour, people. That's never going to work, obviously. This is a huge subject and a subject that's changing. We hit on this very regularly. We need to do it more, especially now, and I'll tell you why. One of the things, though, that I want you guys to remember is you can go onto the YouTube channel, or some of you are watching this on the YouTube channel now, but we have more videos. And in those videos, we will talk about things like underwriting, market demographics, but we'll also show examples. So you can go check those out. And those will help you. Also, the book, Growing Wealth and Storage 2.0. It's hard to even call this thing a book. If you throw it at somebody, they're going to die.
It's a textbook.
Yeah, it really is.
It's got everything in there, man. Everything. And all the stuff that we're talking about today, there's a lot of these examples in there, a lot of the resources that literally numbers, step by step,
everything.
Shows you exactly what we do, what we look at when we're underwriting, all of the different metrics, all the fundamentals.
Some of these things are a little more complicated. So what we've done is we've broken them down. So like underwriting the asset and the art of valuation. All right. So we look at time frames, questions that need to be answered, inputs, Okay. So we talk a lot about inputs that drive revenue up and inputs that actually drive things down. And then we talk about outputs, how those things are correlated, what those happen. So we try to take things that may seem like a lot, break it down into manageable charts, things that you can do. The reason we're mentioning this, obviously, on this podcast is because this is what we're talking about. And it is a lot harder to understand some of these concepts unless they are completely broken down. Purchasing price, NOI, etc. Also, guys, we have it at like $13 because this is a huge asset, or excuse me, it is an asset.
Yeah, very huge asset.
But it's a huge book. We're not making $13. This is basically the cost to print it and get it shipped out. Yeah. We tried to get it lower than I think it was $11, and they would not let us price it lower because Amazon actually couldn't print it and publish it. That is changing, everybody. We're going to be pricing this at $29. That's how much it should be. So with that, you can go get that right now, everybody. Go jump on there, buy it. And if you guys leave us a review, send that review after you read the book review to George. And I know that we mentioned we were doing a big giveaway and we were sending some stuff, and I think George is still going to do that for us.
Fantastic.
So go to Self-Storage Income and you can send it to us there. So this is a lot of these concepts that we're breaking down have been in flux for a long time. And the reason why underwriting has gotten so hard is also the reason why we're seeing better deals than we've ever seen before. Not ever, but because we were around in 2008. So obviously there will never be as good as deals as we saw in 2009 and 10. But we're talking about since then, since probably 2015 or 16, we're buying newly constructed, halfway filled facilities at under replacement cost. We haven't seen that in, I don't even know how long. So a lot of people are confused when they're looking at the market, when they look at everything from prices. And the reason they're confused is the market went from a bull market where it was just everything was full and rates were always going up to over the last year and a half that switched. And for the first time since 2011, we saw actually vacancy rise and we saw rates go down. Now, before you go any further with that, it's important to know we saw vacancy rise and occupancy drop just to normal levels. So when a lot of people are like, oh, it's failing or it's going down, no, it just returned to normal levels. 96% occupancy and raising rates at 15% a year is not normal. And a lot of people got in big trouble underwriting because they underwrote inputs that they viewed as normal because it's all they had seen in 4 years. And historically speaking, it was so abnormal, it was wild. And so underwriting is involving taking the inputs that we're seeing and trying to come out with not only what is actually provided, tax returns, things like that, but you've got to look at what the future of that cash flow will look like. And so you're taking in these inputs. So obviously when that changes, the output changes. That had gone up in the air. And we saw that curve and that change, and market capital went away. It stopped chasing assets because interest rates went up. And that meant that the price that people would pay lowered. So you had vacancies rise, rates drop, and then prices to buy the asset. So that first stuff's intrinsic, extrinsic, the price to buy the asset, that also dropped. And when I say dropped, I don't mean drop as it dropped in corresponding with revenue. It dropped as far as the multiple that people would pay. In real estate, a multiple that you pay for an asset is described as a cap rate. So we saw cap rates go up, which meant prices went down. And those three things combined made a lot of people very confused. It's very easy to underwrite an asset when it has always been full and rates have always gone up.
It looks easy.
It looks easy. Yeah. It looks good. And you just simply plug those numbers in and you're like, look how easy this is. Normal market times though, which we've returned to, that's not how it works, right? There's product demand. There's all sorts of things going on in the market that need to take into account, and you need to look at it a lot more wisely. So that stuff we're involved in underwriting. When it comes down to the price that you're going to pay, that can be different for a lot of people because that can be predicated on how you're doing it. Are you using cash, leverage? What type of leverage? And how much do you have to pay for that money? Those things are taken into account. The first thing we do, though, when we want to underwrite, we're not really going to touch much on that, because what we want to focus and talk about in underwriting self-storage is what is the value of it, the intrinsic value, and what that future value may look like. That value is predicated on net income. What, after everything that takes care of, is that net income? Will that net income rise or lower? That is essentially how we get to the value, because net income, then, everyone, is traded at a multiple to get to what people will pay for it. Now, that multiple, that extrinsic value, is a cap rate, and that goes up and down and changes on things that have nothing to do with the value of the asset. Meaning that 2 years ago, we have assets that were making less money than they are today, and they are still worth less on the market side, that extrinsic value, because people are willing to pay less. Theoretically, that doesn't make sense, right? Because net income drives value. So if net income goes up, the value should. That's why we're not going to get very much into that second part, because that changes a lot, and it changes all the time, and it changes based upon buyers. So when somebody sends a deal and says, hey, this is $2 million, is this deal worth $2 million? Should I pay $2 million? Or should I pay, what's it worth? And I'm like, what?
Yeah.
Okay, just because the owner's asking that, I need to see rent rolls. We have to underwrite it to see what it's worth, right? This isn't like housing, right? This isn't a stock. So the complexity of it is complex enough when you don't mix in the extrinsic and intrinsic. When you put those two things together, it's a whole nother layer. So when we're looking at underwriting, we're going to focus on that today. The intrinsic value, net income, what we're looking for, how to understand the value, and whether that value will increase or decrease over time. And that's the heart at what we do. We don't treat it like a real estate asset. We don't treat it like it's something traded. It's a business.
Exactly right.
We look at revenue, net income, how we'll increase that. Markets will do what markets do. They go up and down. Sometimes you're on the good side of that, and other times you're on the bad side of that. And we know it has been very hard. And we've had lots of assets that, even though we underwrote it at a certain way, guess what? The market didn't care. And so the market changed and they performed differently, and they underperformed predicated on our underwriting. Now, that's a shift, because 10 years prior, everything had overperformed every single year for a decade than we'd underwritten, right? We understand that. And that's why we want to have our margin of stupidity, and we want to have variance. We don't want to get in trouble. We want to be able to let markets do what markets do. We're going to talk about how you do that and what we're looking for in this episode. That makes sense?
Absolutely, man. And I think that's one of the biggest questions that so many people, especially starting out, have is one, the value. Like, how do I figure out what the value is to me, and therefore what I can pay or should pay for an asset that I've identified or an opportunity that I've identified? And then also that piece of, what are those controllables of the intrinsic value that I can affect once it's acquired, and then drive that over time? What does that look like? So I'm really excited to dive into it, man.
Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class when dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process. They are bar none the best. So if you are looking to automate your facility or operate it in a best in class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description.
Touching on that, fundamentals of intrinsic value, what can we control?
So the two sides of controllables are a handful of different things. First of all, the controllables that we look at are the things that go into running the business day to day. That can be revenue collection, that can be marketing, adding on products, that can be things that we can't control outside, maybe like demand, things like that, but we can actually change our success rate internally. And so by therefore, making it more beneficial because we change our operations at a lower demand. Simply put, if we increase our conversion rate, so if 100 people come in, you get 5, you have a 5% conversion rate, okay? Now, if we increased the conversion rate, meaning how we sell, so who's coming in, are we selling better? What is our pricing strategy? What does our materials look like? How are we treating those customers? All those different things. We may be able to increase our conversion rate by not a lot, but maybe we increase it and we get 5 new people. Well, we've essentially doubled, though, that overall rate and how many people are moving in, even though the 100 people didn't change.
Exactly. Sometimes you can increase the value of the business once you acquire it without also increasing cost.
Yes.
And so that's where it really comes into play, where what are you going to do and what is the value to you when you come into it? Because you could go and throw a bunch more money at ad spend and drive, 200 leads to a facility. But if you're only closing 5%, I mean, you're wasting money. So if you can
not increase that ad spend, double your conversion rate, you're way better off on both the expense side and the income side. And that's something you and the team track religiously. Every single facility, every single manager, you look at how many leads, what their conversion rate is, you set goals for them, where are we supposed to be? That's a big, big focus because we can't control that demand. So if demand lowers in a market because there's not as many renters, we can't make people rent. So we have to turn to what we can control. And that's a big focus, and it's worked very, very well for us.
Yep. No, it's really, really important. That's just a big piece of that intrinsic value, looking at those things that you can affect. You hit it on the nail on the head talking about demand. You're not going to force anybody to go and get a storage unit. Every single one of those leads is life and death, and we've communicated that with our team. And like you said, we track that religiously, where we were just looking at figures recently. There's a facility that we have right now where leads from a third-party referral source cost us $600. So getting someone to that door, to that facility, that phone call, that's $600 that we just spent to get that person there in the first place. And obviously, we look at other factors like lifetime value and these other things to make sure that that $600 is actually worth getting that person there. We obviously don't want to pay for people to come and use the facility and lose money. So we look at that lifetime value and make sure that cost is going to actually, that lifetime value exceeds that cost of acquiring them. But again, going back to that point of, and if you have 10 of those people not coming through, $6,000 later, you've just wasted all of that money just because you didn't answer the phone, provide good service, follow up with a lead that day, follow up with them in the first 5 minutes. Those little things really add up. Little side note on this. We had one of our specialists at one of our facilities, one of our employees, their closing ratio, they were consistently 70s, 80%. They were doing really, really well, which is right now where we target. We tell people, hey, we want that 80% closing ratio. We want to see at least 80. And so that's the goal that everybody strives for. This individual was consistently hitting that. And so we called them and said, hey, what are you doing? How are you doing that? And they're doing everything that we told them to do. And all that they're doing is consistently hitting the leads as soon as they come in.
Yeah.
That's it. They weren't doing anything, no magic bullet, silver bullets, no nothing, just doing the framework of lead follow-up and management that we've provided and getting to that lead as soon as humanly possible. That was it. That made the difference right there. And again, you look at where the revenue could be with the facility and where occupancy is with your facility. Therefore, if you just imagine, let's say you're closing 10% of leads, look at that facility and say, okay, what if I was closing 50 or 60% of the leads coming in? Yeah. Even if the facility looks like it's doing good on paper, you're like, oh man, we've got the occupancies going up. We've got this many move-ins. It's like, okay, well, how many leads came in that actually moved in?
And you can't change. So one of the things that people don't understand, but I'm full. Okay, but you shouldn't be full. People are like, yeah, but I'm 100% full, so I don't need to do ad spend. I don't need to do anything. That doesn't make sense. If you're 100% full, you have nothing to sell.
Time to
that
drive
means your
revenue.
Prices are way too low. Yep. So for us, we want those conversions up, and we want to get more people in the door because then we're finding people that need it the most, and we're increasing our own demand. So now we can lift prices because we have more people that want our product than product that we have. Supply and demand 101. So when we're underwriting, we're looking at this. At that facility, what is the cost for them to bring in a new customer? And lots of the time, they're like, I don't even know. What are you talking about? It's open. We have a sign up, and sometimes people come in and sometimes people don't. Love that answer, right? And they're 100% full. So first of all, that means, you're so far under market prices. We have a big room to work, but they've allocated no expense on getting new customers. Well, we need to underwrite an expense to attract new customers. And then we need to understand what the correlation to revenue will that look like. Now, when you are underwriting, we have the cost, right? And then the return on that side. That's essentially what we're trying to figure out. Now, there's other things that we look at that don't really have a direct cost. They may have a outcome that is either good or bad, but not a direct cost. And what I mean by that is we look at the rents and the economic occupancy, and we look at where that economic occupancy is. Physical occupancy is if I have 100 doors, I have 100 locks and people renting those doors. Economic occupancy is I have 100 doors and I have 100 locks and people renting 100 doors, so 100% physical occupancy. We charge $100 for each one of those doors, but on average, we are only getting $50. That's a 50% economic occupancy. So the question is, why aren't people paying what is being charged? Well, they got discounts, or that was a long time ago. So then we look at, okay, we're moving everybody up to 100% economic occupancy. I want 100% economic occupancy, not 100% occupancy. If I move $50 to $100 and we lose 20% of our occupancy, I am so far ahead, it's not even funny.
Exactly.
And not only that, now I have 20% that I can fill up at a new rate and even higher. So when I look at that, I don't have a direct cost associated with changing those rental prices and getting to 100% economics occupancy. I do have an outcome, though, that you may say is negative, and that's that we lost renters, which affects the net income. But it doesn't mean just because you lose renters that it affected the net income poorly. In fact, we lost, 25, 30% during this winter.
25, 26, something like that.
Yeah, almost 30% really occupancy we lost this winter.
Yeah.
Our net income went up in every single facility.
And we're not talking like small decreases in occupancy either. We're talking going from like 80s, 90s to like 60s, 70s. I mean, dramatic drops in occupancies where, I know the revenue looked good, but even I was looking at occupancies haven't seen this for a while.
Yep.
So, man, it's pretty wild. But yeah, you got to focus on those things like the revenue. Revenue is king. Obviously, occupancy is number one. Driving revenue is next.
The reason why, though, we say occupancy is number one, meaning that you can't affect revenue and rates if no one's in it.
Yep. And sustainability is also a really important factor there where, if we had seen sustainable move-ins and while we were increasing revenues, obviously, we would have kept doing that. But we weren't seeing a lot of move-ins. So therefore, we're ebbing and flowing, right?
Because you need to be able to replace.
Exactly. So that was really key to all of that decision-making. But something that you're alluding to is the spread that we like to call it. And this is really, really important in underwriting. So do you want to touch on that a little bit?
Yeah.
And again, being able to identify value and what you can do once you actually achieve.
So this comes down to the spread, or as we call money on the table. So when I'm looking at a facility, we see something like an economic occupancy that is a 15% difference. So there's a 15% spread on what they should be getting and they're not. Another thing is we see a lot of operators that they're not good at collecting rent. That's really weird to say aloud, but it's really true. So they have delinquency that is like 10%. So right there, we look and we're like, there's a 25% spread. 15% on the economic occupancy. Let's say we lose 5% to close that gap. Okay, there's a 10% spread, right? Now, there's also a 10% spread in delinquencies. This is on gross revenue. That's a 20% spread on gross revenue by us cleaning up the operations in the facility. That is money on the table that we're like, we should just be getting. We don't need rents to go up. We don't need the market rents to go up. We don't need the market to have more demand. Nothing. That's just today, what's happening existing. The next thing that we look at for our money on the table is that expense side. We look at fees not being collected. We look at insurance that's not being collected and what rate of the payback on that insurance are they getting, if any. All of those things go into based upon your current occupancy, on your current operations, what is the spread and what is the money on the table that operator is leaving there, not future, not anything else. When we underwrite, guys, this is the heart of our entire underwriting. It's to identify that.
Exactly.
Not market. It's what can we get from it based upon what's happening today. This is a very, very key part. The next thing that we would underwrite, so let's say that's a 15% of gross revenue. Okay, well, if you have a 20% after debt margin, well, you just increased the gross revenue by 15% and didn't have to do anything to get it. That's straight to the bottom line. You made so much more money and you just increased your overall market value dramatically because your net income rose so much. That is what we look at. We also look at that because that's protection against if downsides come. This is what we did on assets that over the last 2 years was where we're actually up higher in revenue, everything, even though market rates dropped substantially. It's not what we wanted to see because we can't hit achievable levels that we wanted prior, but because we had our margin of stupidity and that money on the table that we could take and do, we increased that net income. Therefore protecting us even though markets went down, right? So it's not only underwriting to identify what is being missing, but it's also underwriting to say, are we underwriting to where we expect the market to stay the same or go up? And that's how we make our money. If that's the case on our fund, particularly like the fund one, everything, we would have been in so much trouble, but that's not what we did. And just because the outcome, you're like, I wish rates were higher, everything else, but I can't control the market. So we don't want to plan on that. So our margin of stupidity is predicated on that and the money on the table. We underwrite a lot looking at that. What can we do that affects that? The next thing is the expenses associated with that. We have two sides of the expenses, everybody. You have expenses that are correlated with the physical asset. So CapEx, okay? Then you have expenses associated with the operating part of the revenue. One of the things that we see vastly is operators that are selling, they want to maximize their price. So what they do is they reduce the amount of expenses that it really takes to run their facility, meaning they won't put in somebody that's working. Oh, we have no salaries at all. Well, then who's running the facility?
You see that everywhere. Yeah.
And it's like, okay, but you're working then to run the facility. Yeah, but I'm the owner. Okay, so then you're going to work for me for free?
Right.
So you're just going to stay on board work? No, I'm not going to do that. Well, then I have to hire somebody. That doesn't even make sense. To operate that facility, what does it cost to take? And that's a huge input. So if you have a facility that makes $50,000 a year, but you had to pay somebody $30,000 a year to operate it, instead the owner just does it and works for air quotations free,
right?
Then all of a sudden we make $80,000 instead of 50. That's huge when you're talking about a multiple. So we see things like that. Or, well, we don't have any ad spend. Okay, but you did for the last 3 years. Yeah, but we turned it off. Yeah, you turned it off because you're selling. So you don't want that expense to show, right?
It's actually really important to touch on, because obviously we're talking underwriting, we're talking projections. There's obviously all these different levers that you can pull to affect the value and increase, that value once you acquire the property, and you can project those things. But one of the key pieces about projections is using, like you talked about, the actuals of what's happening right now today, not only at the facility, but in the market, but also what's happened in the past, and using that to project what's going to happen or what you believe could happen in the future. And what are some of those things? You talked about owner compensation, you talked about CapEx, where you've got these differences where, the net operating income could be, $100,000, but then they have all these expenses tied into other expenses, and the net income's actually nowhere near where it actually would be.
Yes.
So what are some of those different things that people should be looking for when they're reviewing the P&Ls, especially to say, okay, this doesn't make sense?
Yeah. So the one thing that we look at is the lack of expenses and the lack of CapEx. So we see this all the time. I was given a facility that somebody in our groups, so we underwrite with our groups like in real time. We pick facilities, we do the market analysis, everything else. And the facility that they looked that was on the market, they were saying that they had a 12% expense ratio. They said they had zero capital expenses underwriting. None. Nothing will ever break. There's never been a problem. They have no labor. They have no anything included in it. They pay $100 for all financial services, meaning your attorneys and accountants and everything else. $100 is what they underwrite.
Red flags are going off.
Yeah, exactly. So the first thing is that you got to look at is that's not obviously actually what it would take to run that asset. That is what is being shown. Very, very different. And so you need to go through there and say, what does it actually take to run this asset? And then plug in those expenses. Their expenses don't matter. We don't accept anyone's expenses. So when we're given a deal and they're like, oh, here's the expenses. It doesn't matter to me. I know what the expenses are for me to operate it. So I'm going to plug those in, look at the revenue, and that net income is what I'm creating value of. Whatever they can do holds no relevance outside the things that cannot change. We're talking about utilities, right? Things like that we actually see bills for and go, okay, those are expenses that are correlated directly with the physical asset, right? But not the operations. And so we obviously need to know all of those. Those are unchangeable. The next thing that you need to look at is the expenses in the future. And so meaning if you're going to operate it, what are your goals associated? If we need to fill that facility up, we're going to have a lot of marketing dollars, ad spend put in. Capital expenditures. Is the facility in bad shape? How much money do we have to put into this facility to maintain it? It's a physical asset. You have to maintain the physical asset. So there will always be expenses associated with buildings, gates, concrete, camera, on and on and on and on. And people will always run into the buildings, okay? So you need insurance. How much does that insurance cost? Another thing that is vastly underestimated by owners. Well, I pay this insurance. Yeah, but that insurance was predicated on $1 million, the value that you stated when you built it, but you're selling it for $4 million. And also your taxes were predicated on the $1 million, not the $4 million you're selling it at. That's not how underwriting works. You take the expenses as it will be under the asset you're buying. The asset you're buying is on the market and you're buying it at $4 million. The taxes are associated with that. Taxes work different in every single state. Some are disclosure, non-disclosures. We're not tax professionals. You need to go ask them. They all do adjust though, right? So you've got to make sure you understand those things. If you have a broker that is good and at self-storage and as a self-storage broker, lots of times they will help you through some of these things, right? But other times it's off market, or two, you get brokers, we see this all the time, that are selling storage facilities. They've never underwritten a storage facility before, and their underwriting is completely wrong. So you need to be aware of that, and you need to look out for that. So all of those things go into it. How much does it cost to keep the facility open? What do I need people to do? Answer the phone, collect rents, right? Is there someone on site? Is there not? Is this automated? If it's automated, what does the tech stack look like? How much does it cost to have that tech stack? And who is doing the servicing? Because servicing is always a need. So those things go into the operations of it, right? The expenses of it. When we look at the revenue side, we're taking in market numbers, what they're currently doing, right? And what opportunity there may be, i.e., is this a poorly ran facility and they're substantially under market rates? Now, they could be substantially under market rates because their facility isn't up to par with the market. You have a climate-controlled, multi-story extra space, and you're buying a drive-up that does not have pavement. It's not, there's no office. It's junky, and you think you can get the same rates is delusional. So don't underwrite like that. You need comparable competitors and prices. And then you look at, are they above or under market? What is their occupancy in comparison to the other? This comes down to the sustainability of the revenue that you're buying and the future of that revenue. That's what we're underwriting for here. First and foremost, our first underwriting is though, we're only looking at what is there, not the future at all. So is this in line with the markets, or is this a short-term thing that I'm buying and it'll actually be lower, right? Because it's not in reality. So when we look at it and we see, no, you're under market rates, you're full, you don't advertise things like that, and you're substantially under market rates, okay, that's a very sustainable market rate. In fact, we think we can push that predicated on today. That's what we want to see, right? If you are above market rates at a less quality asset, this is where we start to look at the rate runway, as I call it. And I talk about this in the book, where it's the rate runway. How long is it? Are those rates going to go up, or is the rate runway backwards and those rates going to go down? What you're buying today, what is the resilience of that revenue, and what may that play out in the future? Once again, not saying that occupancy and rates will go up from the market, predicated on what you're buying today. That's a big, big part of what we're looking at. When we move into the future of it, we want to look at the historical inputs. So we talk about drivers, things that drive revenue. Demand drives revenue, okay? So demand, meaning you have, 1,000 people that want to rent storage. You only have 500 units. You can push those prices really high because they are all fighting over trying to rent those units. Now, the opposite is true, though. When you build a new facility and they open up 1,000 units and you only had 1,000 people that wanted storage and you already had 500 units. Now you have 500 more units than the market even wants.
Right.
So now you have empty units and you're competing, which means rates go down. So when we look at the future, I want to see, is the market growing? Are we having more renters being added in that market? And is supply underneath what is currently being offered? And is that going to change? So we look at facilities that may be built in the marketplace. We look at, and we go and we talk to the county and we say, hey, where is land that storage can be built? Is anyone put in anything to build storage? Is there anyone working on storage? We want to see all the supply and demand metrics and if those are going to change within that marketplace. That will affect the future demand of what we're buying. Therefore, it will affect the future revenues of that asset. And sometimes people are selling assets because they know Bob's building a ginormous storage facility a half a mile away, and the current revenue that I'm getting will not last. So I'm going to sell it to somebody because we're at the high point of this asset. This is normal. There's reasons sellers are selling. That's why I want to know the reasons. If it's bad, they're never going to tell you. But I always ask, why are you selling, right? Yeah. And then we also ask, do you know of any competitors moving in to this area? We want them to have to say yes or no and hold them to it. We don't listen. We do our own homework, right? We don't take it for whatever they say. But that's the future part that we're looking at. So you have how much it's making today based upon its occupancy and what it's renting. We have what it costs to maintain whatever it is you're buying at that current net income and revenue. And if that's reasonable in reality or if it's going to change. Then we look at all the things that are missing, the money on the table. So today, what can we do? Then we look at the market, we look at demand, and we look at that asset in relationship to the rest of the market. Is there opportunity there that we can move up? And then we look at how much would it cost to capitalize on that opportunity. From there, we look at the market as a whole and the future of it, right? So is this a moment in time? Is this a 1-year thing and they're going to build so much storage and they don't have any growth rate at all? Or do they have no new storage that's being built and this market is growing at 2% a year and everyone's full and raising prices? So the future runway of those rates and revenue. These are all things we're looking at. Expenses in the future, taxes, all those kind of things that we're looking at. What is the expense runway? Are they going to go up? Something obviously that's been huge in the last 3 years, where in the last 2 years, we had occupancy go down and rates go down, but expenses went up. So in markets that you have new supply coming in today, because this spring we saw the opposite. This spring we saw stabilization, rents and occupancy go up. So it was like we're out of that little hole. But we're back to a normal market cycle where not all markets act the same. So there's some markets that are overbuilt. That means that it will continue to have more supply than there is demand, and we don't see anything changing that. The main driver that changes that is people moving. Interest rates go back down to 3 and everybody can buy houses and everything else like that. You'll see it increase. But right now, that's not on the table anytime soon. They may start to lower rates, but it's not going to be anything that is so substantial to dramatically change the rate of people moving. Now, different markets have different rates of people moving into it and also moving within that market. The other thing we look at is the regulation of the market, all trying to figure out that demand part, right? And just if what we're buying is stable, you want to look at the history of that asset. Guys like These have been my rates. I've been 100% occupied 5 years. There's no new storage facility coming in. Demand's not changing. It hasn't changed. Even over the last 2 years when interest rates went up, that shows you a very stable revenue outlay, right? And a very stable supply and demand. But not all markets are like that. We have new supply coming on board. We have different things changing. So you need to understand those things and how they're affecting it in real time. We put that all down on paper. Everything we just talked about. We put it today. Okay, what's year 1 and 2 look like? What can we do? What are the costs associated with that? Capital expenditures, operational expenditures. Then we look at what the future growth of that market may be. And as we put those together, all those things affect net income. Net income is how we view value. Will that net income be higher in 5 years based upon things that I can see and measure? Not, well, real estate always goes up and Mr. Market just makes things worth more. We do not plan on Mr. Market because Mr. Market will kill you just as quick as he'll make you rich. So get him out of the question. Based upon what we can measure, will demand stay high? Will rates go up? All that. That is what we're doing when we're underwriting. How secure is the revenue? What is it? And will that net income rise or fall in the coming years based upon what we can see? Then, what is the associated expenses to maintain that net income and increase it? And what are the effects of it? That is what we underwrite for. Everything in a spreadsheet, all we're doing is putting in those variables and we're second checking them and quadruple checking them. And we're looking at ranges.
Yep.
What happens if these things change and what range will we be in if it goes wrong, right? And how does that look? And what would it take? What inputs coming in would take to really hurt that revenue, that net income? What are they? What can we identify? Then what is the likelihood of that happening, right? And what would it, like if we had 500 units come into this market in a 3-mile radius, what will that do? How many units are currently there? How many renters are there? i.e., what is the percentage of inventory that's coming on? If there's ever 10+% new inventory coming onto a market, I am concerned. I am very worried, and I want to really understand that, especially when you're at 85%, right? Because if there's no demand outside that, if you have low occupancy and lower rents and new inventory coming back on, of course it's going to affect the market. It mainly affects the market because that person needs to fill up, so they drop rates, so they're the cheapest in town. So it's a spiral effect, right? So we want to understand all of those things. Other places, everyone's full, raising rents, and you have 500 units coming on, but it's like 3% of the total market because there's so many units. And you're like, there's not even 3% vacancy in almost all our units. Doesn't matter. We won't even feel the effect of it. And at their building cost, they may need to raise price or they may have higher prices. It's awesome. Publicly traded companies, though, they do anything they can to fill up because like Connor said, number one thing, occupancy, meaning if you have an empty facility, you have no revenue, you can't do anything. Outside that, revenue is the number one thing. So what they do is they get people in at any cost. They drop prices down to nothing because once they get them in, then they can change the price that they're charging. And so that's typical that you see, especially in weak markets, they just slash prices. Inputs have effects in markets and your asset. That's what we're trying to know. We spreadsheet those out. We look at different scenarios. Then we decide what we're willing to pay for that net income and what it costs for us to pay for that net income. The cost of debt, right? The cost of investors, and what that will do to the net income. This is why assets are trading at higher cap rates, i.e. lower prices, because the cost of 8% interest versus 3% dramatically changes that net income. And net income is the only thing that matters. But when you look at pricing an asset, this is important, everybody, you don't include debt. So when a broker puts an asset out to market and says it makes $100,000 net, that's not including debt. You don't include it to come up with the value, but it doesn't mean that it doesn't matter. The reason you don't include it is because it's different from everybody and some people aren't going to use debt. So you could actually never say what that debt was going to cost because that's individualized. The person, the firm. Some people may not use it at all. So you can't underwrite when you're selling an asset with that. But when you underwrite, You absolutely have to underwrite with debt in because you're going to use it.
And
it's
a really important distinction between that net operating income versus net income.
Yes.
Because net income, that's the bottom line.
The bottom line
that you end up with. Because like you said, the debt service, it's not included.
Yeah.
So you have to take that into account because you think, going in, you're going to be making X amount of money with debt service. And then
you're not making anything with that. You're like, oh, man.
In terms of the debt service, with interest only periods, and then once the principal and interest kicks in and planning for those things accordingly, all really, really important. The other thing too that comes to mind in that bucket, you touched on insurance and buildings getting hit and different things that happen at facilities, and it made reserves come to mind for me, which is another one of those things where that's not part of the net operating income. You're putting your reserves, after that. It's really important to have those reserves for a number of reasons. Yes, you have insurance, but I can't tell you how many times we've had issues happen at facilities where we have to have insurance get involved, but insurance could take 6 months to get something done. Where there's been times where we dip into reserves, get repairs done, and then seek reimbursement from insurance just to get the facility
We need
going.
that gate working. We need something to happen. We can't shut down business.
Yeah. So that said, what would you say is a healthy level of reserves to be underwriting?
So we allocate 3% usually, but we always start with reserves. So when we buy it, if the asset cost is $3 million, well, we may have 3.3 million because we need to put reserves in there. And depending on the asset's shape, what needs to be done will be predicated on that reserve level. So the bigger the asset is, right, the more run down it is, the more CapEx it needs, the higher the reserves need to be. The more unknown things are, the higher the reserves need to be. How big your net income is will determine the reserves that need to be. Meaning that if you're buying something that's a turnaround and it has very little or no net income, you need to have big reserves. This is what development looks like. You have operating reserves because you don't know when you're going to break even. So you look at, we're going to run negative or almost negative for years. So how much money do we need to pay for this facility to run until we get tenants and occupancy up and it turns around? But you don't know. So if you're planning on a year, which I actually saw somebody do, somebody gave for a feasibility study.
Yeah.
And in the feasibility study, they said 9 months. 9 months. Wild. I've never seen anything
insane.
Like that.
It's a major demand going on.
Yeah. And that was right before everything turned and went south. The average that we use and you should use and banks will normally require is 3 years. Now, it's never taken me 3 years to fill up a facility, ever. It's never even taken me a year. I would never not put 3 years worth of reserves. Why? You can always get the reserves back. You can distribute them, okay? So you fill it up in a year and now you're hugely profitable and you have 2 years left of reserves, pay it back to yourself. You get the money back. But if you go 3 years to fill up and you only had a year of reserves, you're running negative and you have to take out cash from yourself, from investors, or the bank is going to reclaim your asset.
Bad place to be.
Bad place to be. So on a cash flowing existing asset, if I have an insurance that my deductible $10,000, obviously I need that. But there's a lot of things then that if I have a deductible of $10,000, I'm just using an example, everybody. I'm not saying that this is what it is or anything else. But how many items at under $10,000 are we going to have that need to be fixed? Lots. So how many times does a lock break? How many times does something in the office go down? How many times does a computer go down? How many times do we have to hire somebody to come out to fix something? This happens all the time. Okay. So we need reserves associated. The more that needs to be done to the facility, the higher those reserves will be, right? Newly constructed facility that we have, brand new, just out of the gate, 50% occupied, which we just bought, whatever it was, 4 or 5 months ago. Our CapEx and reserve needs for that's a lot lower, but our operational reserves might be higher because even though it's 50% occupied, right? It's not fully occupied. So then we go, okay, operational reserves, but the asset's brand new. It may even be covered under warranty for the first year. So we have a lot less worry about those things because the builders, everybody's going to have to fix it, right? In this example. Other examples, though, are we buy facilities like we bought one in Denver that was rough, really rough, huge asset. We
Massive.
need lots of reserves. And people are like, oh yeah, but I'm going to plan on fixing it. Well, that's fine. And of course you should. You should fund it what you're going to fix. So you're like, oh, so I don't have to worry about it. But what happens when you go to fix it and that $60,000 bill is $120,000?
Exactly right.
And people are like, oh, well, you did a bad job and you should have gotten a more correct answer. You obviously haven't been around in the last 2 years because you went out for a bid and 3 months later, that bid, they're like, we won't even hold to it anymore. Prices went up so much. It's not $60,000, it's $100,000 now. And nobody will do it under that because of those costs and how those costs increase. So you need to be aware of those things, and you don't need to think that things won't change. You need to have good reserves. Even if you're doing lots of work and you're going to do it up front, you have bids, but it's not done. You don't know. So we like to be always holding a certain amount. And that has to do with the size of the asset, things like that. But we're allocating usually 3% of our revenues into reserves until we hit a certain point. And most of the times that's, hundreds of thousands of dollars predicated on our assets and size. That may be lower for you, but that's evaluating what is needed and what could go wrong in the asset. If we are underwriting for things that are $50,000 or $100,000 because somebody runs into a building, things like that, that's clearly insurance. I don't hold reserves for a fire that burns down all the buildings. That'd be crazy because then you're going to hold the exact same amount, right? So it's understanding those levels and what are the general things that need fixed up and occurring all the time. Because in storage facility, there are things that just always need fixed. Every year, you're going to have those expenditures. And so looking at that and looking at the past and what has been needed from that asset too.
So true, man. Really great breakdown. I want to wrap up on this topic. Some of this just been heavy on my mind lately. With as difficult as it's been just recently and over the past few years, I know development has been a struggle for a lot of people.
Yes.
And there's, despite all these things, we've talked a lot about the risks associated in the underwriting and what you need to be looking out for and oversupply and how that affects markets. We've hit on a lot of those things, but there's a lot of markets out there that have the growth, that have the value, that have
absolutely
the amazing opportunity.
Yeah, all of it.
One of the things that I've really been thinking about is how right now really truly is the time to invest in development.
Yeah.
Do you want to touch on why that is because
Absolutely.
of the issue of supply that's going to be available in the next couple of years, and why just now is truly the time to not be on the sidelines? It's time to get in the game, invest in that development.
Yeah. So a lot of people may have noticed our firm is kind of contrary. We built our firm off doing things the market thought was opposite.
Zigging and zagging.
So exactly. So when everybody's saying don't develop and everybody's shutting down developments at huge rates, that to us is the opportunity to come in to develop. The reason being is that lack of supply that will be out on the market, and with demand growing, you get years of undersupplied. That then in turn drives prices up and demand up. So we want to be putting products out, and it takes you a few years to develop. So we want to be putting products out in those markets that are going to be undersupplied, may already be, but nobody can develop. Because as our product's coming out on the market and as demand picks up, it's an exaggerated, piece. Now, we don't develop for the future. That sounds weird. Let me say this again. We don't develop for the future. We develop for now, meaning it has to work now. But we develop, though, because we believe and we see the trends in our measurements and everything, that not only will it work now, it's going to be a rock star because of the lack of supply, the rate runway, everything else. So when we put an asset in the market, if there is not demand for that asset today, I won't even start. I don't hope and pray. Okay. But we go specifically into markets where the outcome will be exaggerated due to those forces. It works today, but holy cow, there's a wave that is coming. So it is forward thinking. And I want to make sure that's very clear. And a lot of markets today, at the cost, at debt, people can't get money. It's not even that the project won't work. Banks will not underwrite it. Trying to get money to develop in the last year has been a nightmare, absolute nightmare. So the banks are shutting down. So even projects that were good and viable aren't coming out. And the cost of that debt is so high, that means it's riskier for developers to put it out. Developers that are not storage operators, they build and then they want to sell it. The reason why development shuts down is the cost of their money to hold it. Their holding costs are so much higher. But then two, cap rates go up, which means the price of value goes down. In markets like today, you have another thing where CO deals, meaning deals that come to market that are newly built, but it's not filled up and not operational, they don't sell. People want filled up assets, right? So a developer that is selling to just throw it out onto the market to flip it, this is the worst time you could ever be developing because people aren't paying premiums. Cap rates are going down, right? And they don't know anything about storage. They're not going to operate it. Even if their net income was huge, even if their cash on cash return was huge, they don't do that. They're not investors. That's not what they do. They're developers, right? So all of those projects get shut down, even in markets that would be viable and good, because they don't have a seller lined up that's going to pay them a 5 cap or a 4 cap, and those $5 million that they were going to make real quick now is gone or much, much lower, and it's now in question. So they stop developing. This is an opportunity because now we have demand on intrinsic value because the demand on the extrinsic value went down. We don't care about that. We care about intrinsic. The demand on extrinsic, it comes up and down. It'll come back. And then when it does, your values spike. But two, because it wasn't there, there's less supply and demand has built up. And we really, really like that.
Dude, I love it. I've been on that kick lately, and I'm like, man, now is the time to jump in. If there ever was, wanted to make sure we hit on that and really conveyed that message because it's not the time to wait, man. It's there's great deals out there, great opportunities. Don't sit on the sidelines and wait because by the time you wait and opportunities there or the perceived opportunities there, it's gone.
It's gone. And this is a lot of things that people don't understand. When the markets adjust and go back, it's always counterintuitive because markets are projecting future. So when all of a sudden the future looks good, there's no risk and there's safety, prices reflect that. If it looks dangerous or unknown, prices reflect that. You want to know what the reality is, not what is perceived.
For sure.
So you get better deals when the perception, especially by non-market participants, is negative or unknown. That's when you get the value. The moment the unknown is gone, the moment everybody's like, yeah, it's going to be great, there's no more deals because the prices reflect that future perception. So I actually want to buy when I know we're going to have some hard years and I don't even know necessarily when it'll get better because I'm getting the best deals.
Exactly.
I'm a value investor. I'm not betting on markets going up or down. I'm simply betting on the asset, the net income that it makes. And when I have to pay a much less price because I also use debt, my returns on that asset go up. So then I want to buy it. But that's generally when everybody else is saying it's not good anymore.
Right.
I'm fine with that.
Yeah, exactly. It's not good for you. It's good for us. Well, with that said, it's been an amazing podcast. A lot of ground covered. Make sure that you guys look at the other videos on YouTube, check them out, get to the selfstorageincome.com website. Go through all of our underwriting materials, go through all those resources. Additionally, we've got a podcast survey in our link in the description here that we need you guys to go and fill out because AJ wants a super tired hand from signing all these books he's going to give out to everybody who does these surveys for us. We want to hear from you guys. We want to hear what you like, what you don't like.
And we make content based upon what you guys tell us.
Exactly
right. We literally take that and say, here's our subjects.
Yep.
You want to hear more about things, get on that survey, tell us what you think, what you like, what you don't like, and we adjust to you. We're doing this for you. Let us know.
And if you guys want to get at us live, we've got our Self-Storage Income
Conference
coming up, North Idaho, September. I don't even know the dates off the top of my head. It's last week of September, one of those.
We'll put them in the show notes, everybody.
Links in there.
If you've been on the fence, this is our highest attended one yet.
Yes.
I'm not even sure how many tickets are even available or even at the hotel or anything yet. Go try to get them quick because I already know it's already bigger than all the previous years. combined on attendance, everything else. This is the event to be. A lot of people that have been there. If you've been there, put in the comments, both on YouTube and give us a review on the podcast. Put in the comments what you thought of it, because that's the best. I just like hearing what everybody that went to saw, because they're always blown away.
Yeah.
Because we go so over the top. It is the conference. You are tight-knit with the people that are actually doing the speakers, everything else, the food, the events, it is it.
The atmosphere is unmatched, and not only for just events in general, but lo and behold, a self-storage event. I mean, it is the best in the world, hands down, no questions asked.
And trust me, we put a lot of money into it. It shows. This is not something that we are doing to make a profit. This is representing us, our company, who we are, the podcast, and the information we deliver. So we put all out. It's all the stops. I don't think it's ever made money. The first year, I think it cost me $150,000 after all tickets and everything were done. Yeah. And we're okay with that. It's not the point, right? We want it to be an incredible experience for you. So once again, people catch on and they've noticed. So it's now bigger than it's ever been, but we cap it. We won't let it be huge. This isn't thousands of people. It's meant to be intimate. That's why it's at the location. It's why we put the money in. We do. It's why we do it this way. So make sure you're signed up and get in there, because we do cap it. We don't open it up. There will not be over 400 people there. We won't allow it. So make sure you get in, and we'll see you there.
Sounds great, guys. Take care. Thanks for everything.
Thanks, everybody.